Recording in progress.
Hi guys, welcome back to the last week of Teach the Teacher. This week we will talk about market structure, which is the one thing you need to understand before any indicator, any pattern or anything else. So, again, same structure. Why did I chose this topic? I chose this because every single paper trade I did this semester started here. So, before I look at any indicator, I ask one simple question: is where is the market in its structure right now? And is this going up? Is it going down? Or is it ranging between those two? So that answer changes everything about how you trade. So this is the foundation of week 6 in the FIT minor. What is market structure? Market structure is just the pattern of high and lows that prices leave behind. That's all. You have three situations. You can have an uptrend market, which is higher highs and lower lows. Buyers are winning every time. You trade for longs. You have then a down trade, which is lower highs and lower lows, and sellers are in control of the market, and you normally short. And then there's the range, no? Range is that the prices are bouncing between the same support, the same resistance, and no one is making money. So you either trade the boundaries or you wait for a breakout. So let's see some action. Look at this chart. I found it on the internet. You can see exactly what I mean. So the swing highs and swing lows are at the main phase of the market, no? Of how the market is feeling. Every time price makes a new high, buyers will buy more, and every time it gets lower lows, it will go lower. It will have a pullward, no? And the sellers are losing strength. So the swings between these points should be your key levels. They are basically where price have reacted before, and you can use it to predict that the prices will react the same way in the future. So there's a few types of break of structures. For example, the one that I used is from my own trade in Bitcoin. It is very interesting. Look at the chart. You have Bitcoin having an upward trend, so higher highs and higher lows. But then the price broke below the last higher low, and that is the break of the structure that I analyzed. So the buyers in this case were they didn't have control anymore, and the trend has changed from that point. When I saw this happen, I waited for the price to come back up and retest the broken level from below. So when I got rejected there, I did a short position. I got a 1.6 risk reward, and yeah, the break of structure gave me the thesis, but the retest also gave me the entry, no, to have a successful trade in this case. So you say, okay, Rodrigo, you show me your example, but how do I apply it to myself? Same as I did in week 5. I'll give you some rules or steps that you can follow. One, you should always identify the structure on the higher time frame first. So are you gonna do a 4-hour, a 15-minute? Are you gonna do a daily? Are we also gonna go up? Are we gonna go down? Is it ranging? So that's the fundamental. Then you can follow to the key levels, no, and mark them. So if swing highs and lows, make sure that you mark them, because they are basically the areas where prices will have a reaction. Third, I would say drop the lower time frame for your entry position of a trade. In my case, I don't know, I did 5 minutes or 15 minutes, and look for a pattern or some confirmation at the level. And lastly, you need to let the structure define your stop. All right, just put it beyond the nearest level. You have some I don't know, some like real structure that you can understand. And if you see that that structure breaks, then your thesis is completely wrong, and you most likely will get wiped out. It is pretty simple. I'm trying to give you a logical process, so you don't need to guess that much. Um, so, to conclude, I would say one statement that I've heard many, many times, that is, please do not fight the market. It's better to read the structure of the market, and therefore make the trades along that structure. Just let it do the work for you. Having a structure is always good. Once you can identify, some uptrend or some downtrend and range in 5 seconds on any chart, everything else in your technical analysis will start to make sense. Thank you very much, and I'll see you in another time. Bye bye.